In order to understand how to get capital to flow freely back through the U.S. economy and through banks, it's important to understand how banks have money to lend. If you think about this entire grid here as all the money that a bank has available, and you look at the different elements of it, it may help you to understand that a little bit better. First, a bank must statutorily maintain a certain level of reserves to have them available for you if you wish to withdraw money. And those reserves are a percentage of assets. The second thing that happens with a bank, of course, is if the bank's making money, then it has more money from the profits going into their coffers. If the bank is losing money, then this area, the loss area, is rising, and they have less capital to lend. And the third area, and the one that most people don't understand, is something called a provision for loan loss or allowance for loan loss. This is a formula that is based upon past losses and also based upon looking forward to distressed loans, loans that are 30, 60, 90 days old, etc. It's a complex formula. You don't need to understand the formula, but you do need to understand that it becomes a huge impact on the bank's balance sheet, not only in terms of how much money they have to set aside for those losses, but also because it affects their profit. And so they're reporting no profits, or they're upside down, or tremendous losses because they have to put all this money aside. As this allowance for loan loss grows, as the losses grow, as the reserves grow, what happens to this area here, which is money to lend? It starts to go like that, and before you know it, they have no money to lend at all. Now, if you remove all of these bad assets from the books, you open up the bank's ability to lend more money. Put it another way, if you look at it in a circular manner, here's your bank. The bank experiences losses. Bank customers start to withdraw money. You have capital leaving the bank, don't you? You increase your allowance for loan losses because of the problems you're experiencing. You tighten standards to make sure that this won't happen to you in the future. And before you know it, you have no money to lend. This is what's happening to the U.S. banking system right now, and this is why the proposals put before Congress are so important. So now that you know all of this, what are we going to do about it? What's going to happen? Well, first, we're going to see a fundamental change in the way the U.S. banking system operates. And probably the most important part of that change is going to be an increase in regulations. You're not going to see the Federal Reserve and the Treasury invest $700 billion or more and not want their pound of flesh. So you're going to see tighter regulations, more accountability to everyone in the banking, credit, and mortgage systems. Secondly, you should see an increase in liquidity if all of this goes through, because the stinky loans are gone. They've been removed from the books and held for later resale, perhaps. You also should see an increase in consumer confidence, because if I tell each and every one of you that your money market funds are secure, that your banks are secure, that your deposits are insured by the FDIC, and that liquidity is returning to the market and there's money to lend to buy homes, you're going to feel better. If you don't hear those things, you're going to feel worse, and you're going to buy gold or do some other thing to save you from the impending disaster that you expect will be coming. As in everything, the devil is in the details, however, and what's going on right now is that the federal government, the Treasury Department, the Federal Reserve, the administration, and Congress are all working very, very hard to figure out how do you apply this in a way that congressmen can accept, because as you know, this was turned down, this proposal was turned down on Monday. Well, it's not all bad news, and I don't want to end with a real bad news scenario. Let's look at some things that have happened that are actually very positive. First, I told you about AIG before, this $1 trillion insurance company that received a huge cash infusion. I don't remember the exact number. My memory tells me it's 80 billion, 70, $80 billion. Well, the shareholders of AIG have gone to the federal government after this bailout last week and said, look, give us 90 days. We will sell certain assets that AIG holds, and we'll pay you back your $80 billion. And by the way, the federal government lent that money at 11%. That's not a bad return in today's economy. I wish I had it. Secondly, another vote of confidence. Warren Buffett, a man that many of you certainly know about in some way or another or have read about. Warren Buffett has decided to spend $5 billion of his own money to buy shares in Goldman Sachs. This is a clear indication that he believes the Goldman Sachs, which is an investment house that's been around for a long, long time, is ultimately going to be a very profitable operation. The third thing that's happening is that there's this changing of the tone from a bailout to a buy-in. In other words, the federal government is saying, you know what, we're going to invest all this money in all of these failed companies and in these bad securities, but in exchange for this, we want our pound of flesh. We want warrants, which are an opportunity for us to own stock in the corporation or own the whole corporation when it gets back on its feet. We want a good interest rate in return for our money. So there are some hooks that are placed on these apparent giveaways. So the government is now characterizing this as a buy-in rather than a bailout, and I think that's positive. Also, I think you'll all agree as real estate agents that existing sales are up. Open houses are strong, particularly in the low end of the market. We're seeing an awful lot of activity there. And our broker, Mike Hickman, has coined a phrase called pre-bottom, which I think is fantastic because it indicates that we are at a place right now where we're very close to the bottom. We don't know when it's going to come. No one could ever hope to know exactly when it is. But we're getting so close to it, and with the interest rates where they are today, we think this is an excellent time to buy real estate. So what does that mean to you? Well, first, in the short term, I think it means that we're going to see excellent interest rates. I think they're going to remain low. We're going to see a tremendous amount of volatility where one day interest rates will shoot up and then drop back down again, particularly in what we call the conforming area. That's that area up to $729,750. We expect that more buyers are coming into the market, and we see that as a big positive. And we think that the market will stabilize once the money supply is freed up to lend. Some wild cards, long-term issues that I think we have to pay attention to. First and most important, unemployment, or employment if you prefer. California economy has suffered its greatest blow when there was tremendous unemployment. And right now, 7.7% is not tremendous unemployment. It's just a bothersome increase from where it was a year ago, because a year ago it was at 4.4. So if unemployment continues to rise dramatically, this could be a problem. The second area that we want to really pay attention to is consumer spending. Consumer spending represents 70% of the U.S. gross national product. And I don't know how many of you are planning on a big Christmas, but I think if I were to see people raising their hands right now, you'd all say not many of us. And Christmas represents, for many small retailers, 40% of their annual retail sales in one 30-day period of time from Thanksgiving to Christmas. Lastly, inflation. The federal government is taking, $700 billion is not the only number. There's the money that went to EIG, there's the takeover of Fannie Mae and Freddie Mac, and if you've been reading the papers, you'll know that there's a $25 billion proposal on the table for car companies to help them get through their current situation and put more fuel-efficient cars on the road, okay? In order to spend that kind of money, money approaching $1 trillion, something's got to give. Either we make money on this proposal and it ends up being the best bet the U.S. government has ever made, or we lose money and the only way to get more money into the system is to print more. If we print more money, we will have inflation, and that's not good news. I'd like to end this brief discussion by saying to you that I actually have a very positive view of all this. If you think about what happens when there's a forest fire, it's a horrible experience. The trees all burn, the green is all gone, but after a year or 2 or 3 or 4, the forest grows back even stronger than before, and the trees become even more resistant to being burned again. I believe that that's what's happening in the U.S. economy, and I believe that once these proposals have been finalized and put in place, that we will have a better economy and a better real estate market as a result of it. In closing, I'd just like to say that your team at Home Security Financial and SG Western are experienced individuals. We have over 110 years of mortgage experience. And in a time like this, when there's tremendous uncertainty in the financial markets, our expertise can help you to get those deals closed. Thank you very much.